All right, what's going on, everybody? Welcome to our maiden voyage of the Roundup, now on the Forward Guidance edition. We've brought in Jack Farley to send us off with some goodwill. What's going on, Jack? And for everybody that doesn't know about the Roundup, we've been running it on the margin, but we've moved it over to Forward Guidance now. And it's where we round up the news of the week, get our take on some of the action in markets, and look to see what's coming up next. What's going on, guys?
Doing well. Thanks for having me, Felix.
It's an honor to have you here on behind enemy lines, but we love it.
No, we're allies. Wait, Tyler, what are you laughing at?
I thought you were going to dress up for me, dude.
Well, I mean, I know what you're going to dress up. I always try and match what the guest is dressing. You know?
Is that what it is? Okay.
Yeah.
Don't stoop to Tyler's levels. That's a place you don't want to go.
Yeah, you can be wearing like pool clothing if you do that.
Quinn, where are you? That chair looks very French.
Actually, yeah, at a nice chateau in the south of France for a buddy's wedding. So, recording this from some dodgy Wi-Fi and missing the cocktail hour just to be with you guys.
Nice.
Honor.
We appreciate that a lot. Well, before we get into it, I want to roll out the red carpet a little bit and give us a little bit of a chance for a little victory lap here, because I do think it's somewhat deserved for a few of us here. So we're recording this on Friday. Obviously, it's FOMC week. We just had the first FOMC cut of the cycle 2 days ago, and they cut 50, not 25, despite 101 economists predicting 25. They went higher on 50. But you know who did predict it? Tyler Neville. Coming in on the 50.
Stop it. Stop it.
But no, I want to give props, seriously, because at this time, I don't know. I don't remember where the odds were when he called this. But
no, I think it was before. But, it's shocking to me how people are not watching forward break evens. It's almost borderline deflationary. And Jack has all these like super expert academics on here talking about, God knows how many like crazy expert economist things, but all you have to do is watch break evens and then, anticipate, look at the 2-year yield too. It's pretty simple, but, that's what the Fed's been doing for years now. And, you can argue about the politics behind it and, with the market at all time highs, but they're really, they're telling you what they're going to do before they do it. So we got it. And, we can put it past us and all the chatter now.
Respect. And yeah, I threw a bet on Poly. I just wanted to try out Poly Market because I keep going to a lot of stuff, and I'm like, man, I haven't actually used it yet. So, I threw in a little bit of money and decided to bet it on 50, and it worked out. So happy about that. And
you buy a steak out of that? Or
I got some sushi for lunch with it. I was quite proud of it. Yeah, that was my lunch money.
Here's actually a question on Poly Market. Can you bet any dollar amount? I haven't done it.
Yeah, pretty much. You like buy shares in the bet, kind of.
Is it liquid? Like you can bet?
The big bets are liquid, but even like the presidential election one, I don't know the $1 million behind it, but I wouldn't like somebody can come in there and move it pretty easily. I feel like.
Yeah.
Quinn, you nailed it too, man. Do you want to expand on what you were mentioning here back in early September and your framework leading into this?
Yeah, sure. Yeah, this was I was a few hours early to this as we dipped back down on that Friday of the jobs report on the 6th, but I think most of the logic held up. I describe it as this funny coincidental timing of the recession fears and weakening data reaching a crescendo at the same time that we're coming up on this like consequential Fed meeting that everybody kind of knew was the first rate cut even many months ago. And behind that, an election that's a month and a half away, a little gap there, and then the next Fed meeting behind that. And I think it all culminated into what ended up obviously being 50. But these fears in the market, as we saw with the yen carry trade and the things that knocked it off, that had people very, very concerned about recession and the slowing growth tipping over. And so it beat down yields, it beat down the dollar in expectation of rate cuts coming. Stocks wobbled, but they didn't really break. We saw cyclicals taking the brunt of it. Energy was very disinflationary vibes. Rumors about China, that always kind of comes back, whether it's actually because of China or not. And so what I view as the narrative now going forward, though, is that the Fed cuts, the Fed put is supporting the market and going to prevent a recession, because as we're already seeing it, this dramatic decrease in yields has reignited housing activity. Bank lending now with a steeper yield curve is much more profitable. That's going to continue to improve as the Fed holds down the short end and the long end rises on higher growth expectations. And so you're looking at the scenario of a reinflecting economy. I think the long end goes higher in yields. And this is kind of, there's some areas here that really confuse people about the dollar, for example, kind of, if the Fed goes too much, they're going to reignite the yen carry trade, when in reality, because they started sooner, they're actually kind of nipping the problem in the butt. And what the market will be able to do is price out a lot of these cuts because the economy will be stronger. So I think interesting price action looking ahead. And I do believe these few days post the meeting are pretty good examples of what's to come on the reignition of the economy and inflation front.
Jack, what was your thoughts leading into it? I know you interviewed a couple hot shots on your new podcast, Joseph Wang and Danielle DiMartino Booth, had some interesting discussions there. What were your takeaways? It was the first governor dissent since 2005, I believe, which is pretty interesting. But what were your thoughts?
Right. I was leaning towards 50 on Monday and Tuesday, but it's interesting how, and it is historic, just how the market didn't really know what was to come. Like, this was the first surprise that I can remember in terms of it not being a near certainty, like the morning of or even days before. You remember, like in June 2022, when the Federal Reserve did a 75 basis point hike, the media and the interest rate markets had to be convinced, actually it's going to be 75 rather than 50. It seems now the Federal Reserve doesn't really care whether whether the market is prepared for something, and that's a very interesting perspective. It sounds like Quinn and Tyler, you've also had this view, but Felix, I just follow you on Twitter and see your telegrams and everything, that your call that this would be a bullish 50, based on yesterday's price action, that definitely has been a correct view. So I just want to roll out the red carpet for you there. And Quinn and Tyler, if you deserve to join, you're welcome to join as well. Tyler.
First off, pumping our own tires here is a real bad sign, because that means we're going to be wrong for the next 6 to 12
Absolutely.
months.
We're about to be down only from here.
Yeah, let's not get too
well,
cocky.
Tyler, well, I'm not finished. Yeah. I've got to say, guys, crypto kind of lagging stocks. Like, stocks are at all-time highs.
Over what time period?
I'm saying crypto is not at all-time highs. Stocks are.
Yeah. Sounds like a beautiful catch-up trade to me.
Yeah, sure. Yeah.
No, I think it's a good point. And like, my nuance there is I'm definitely more bullish on crypto and gold in this regime, because I feel like equity valuations are really elevated right now, that the upside, there's upside, and I'm bullish equities, but I feel like the runway isn't as long as it is for gold and crypto, just because of those earnings multiples that are, I don't know, a bit stretched, and there's some big hurdles to meet there. So definitely easier to represent that view in assets that don't have cash flows, for better or for worse.
having a valuation is a trouble, because it can always be too expensive or too cheap. It's just like the Silicon Valley quote: don't have revenue, because then it'll never be too much. You want to be a pure play. And crypto and gold.
There's some degens in crypto that know that. They're like, getting revenue is bearish, so we're just going to keep doing nothing.
Okay, Jack, get this. I'm just doing the year to date. Basically, since the start of the year, IBIT is up 35%, the SPY is up 19%, and the Qs are up 17%. Crypto has outperformed over the year, even though it's not at all-time highs.
Right, but it was all from January 1st to March. That's what I'm saying.
Yeah, that's fair. I think that's fair. Yeah. I want to talk a little bit about, and open it up also to you, Jack, is just looking at some of the summary of economic projections. I found there's some really interesting components in the economic forecast side of things. This is something where back in June, the unemployment rate forecast for year end was 4%. That seemed low. We passed that very quickly. We went up to 4.3. In 2 prints ago, back down to 4.2. When you look at the actual rounding of it, it's like barely moved. But the fact is we're above that year-end target. So they brought up their year-end target now for 2024 to 4.4, and for that to hold flat for the entire year of 2025 at 4.4, and then to do this beautiful little decrease down to 4.3 after that in 2026. That seems rosy. What do you think, Jack? You've had some interesting takes on this from what I've listened to.
Yeah, I think that's really rosy. I mean, history shows, and those are two dangerous words, history shows, but that when the unemployment rises, it tends to spike higher in a nonlinear fashion, and it tends to be in a recession. So the Somm rule was triggered, and Claudia Somm herself has said that she hopes it wrong. She hopes that Somm rule will be wrong, and that there's a decent chance that it will be wrong. And also, she didn't design it so it's an infallible way to be a macro hedge fund manager. She designed it so that policymakers could be alerted and act appropriately and in a quickly, timely manner. And maybe so the Federal Reserve is paying attention to the Somm rule by cutting 50 basis points, and therefore the Somm rule will be proven false. So that's definitely a possibility. But yes, the odds that by 2025 the unemployment rate peaks at 4.4%, or actually that it will be at 4.4%. To me, I think that's rosy. And the idea that out of all of the nearly 20 people on the FOMC who are writing in the dot plots and making these projections, that the most bearish, the highest unemployment rate that he projected is 4.5%. I mean, I think imagine if instead of being 4 of us today, there were 20 of us. I think that there would be some people who would be in the 4.9 or 5 or 6. And I think it's just optimistic.
Yeah, and then I mean, look at the real GDP forecast that we're just going to stay flat perfectly at 2% for the next 4 years. Like that's the silliest thing I've ever heard.
Yeah.
So there's a lot of criticisms about the dot plot and the SEPs and whether they're useful or just noisy. And I think some of those criticisms are warranted. Quinn,
but it was bullish dots. It was dovish dots and dovish dots. I don't see, my base case is that dovish dots are bullish dots. You can say, well, historically they haven't been, although Felix, you've got an alternative read of the data, but dovish dots or cutting interest rates itself is stimulative. Now, often it is the case that the Federal Reserve cuts interest rates because there's a financial crisis, which is obviously not stimulative. But it's just like saying, going to the hospital, oftentimes makes you better and healthier. But the people who are in the hospital are not healthy people, but that's because they're sick. So it's I think that dovish dots are bullish dots. Joseph Wang, in my first interview with Monetary Matters, and he has been a near permeable, going back all the way to late 2022, 2023. Yeah. He actually had a interesting bearish take that a 50 basis point cut is not bullish because it will weaken the dollar, and foreigners who are massively into the S&P 500 do not hedge their dollar holdings of U.S. stocks, whereas they mostly do hedge their dollar holdings of U.S. bonds, and that could force an unwind, somewhat similar to what we saw in that the horrible Monday in early August after the Bank of Japan raised interest rates, and we had the very weak labor market data, which forced Japanese interest rates higher, U.S. rates lower, and the yen strengthened dramatically, which precipitated a steep sell-off in equities. That's Joseph is a little cautious. With Felix, you as a podcaster and me too, we pay attention. We have our own views and we do our own analysis, but also I think, at least for me, some decent part of my analysis is paying attention to people. And if someone always thinks there's a recession and they say they think the recession is like, yes, okay, that's like saying, oh, Kathy Wood likes Tesla, but if someone who is a giant Tesla bear and actually says, you know what, I'm seeing the fundamentals and I actually am bullish Tesla, I pay attention. And likewise, when someone who, has been very bullish stocks like Joseph Wang is cautious, I pay attention to that.
Yeah, agreed. When Joseph talks, I definitely stop and listen. And he's been very prescient. I don't know anybody else who has a better tracker than him the last couple of years.
Can I play contra to that? Because I like disagreeing with Jack just because,
bring it.
Naturally, I just want to disagree with you. So I want to hit you with a couple sentiment charts on sentiment slide 42. This is the share of CFOs who say now is a good time to take greater risks. And it's at new lows, which is just really, I find this so fascinating. Markets at all-time highs and CFOs are just so risk averse. And in the Fed's beginning an easing cycle. Then go to the next slide. This is the Bank of America fund manager survey. The net percentage taking higher than normal risks is so low. So the positioning for a lot of people is really negative. I'm getting more and more bullish here. And one thing that I find so fascinating is nobody is looking at the fixed income market. Like the thing I saw is like, oh, every time they lower rates, that's a sign that there's some demons in the system. And you're like, no one's even looking at high yield bond market. Like check out, slide 44.
Spreads are narrow.
Spreads are coming in, and you have this Goldilocks scenario where growth is good, inflation's falling. They're buying high yield bonds hand over fist. Not only that, but we also have this demographic, boom, or a demographic like rolling over where baby boomers want yield, and so they're going further out. And then the balance sheets of high yield are even getting better. Like there's some upgrades. Like this is a great chart from JP Morgan, slide 41. This looks like we're starting a new credit cycle.
We are. Bank lending is reinflecting higher.
Exactly. So this is the last 12 months upgrades to downgrades. It says the number of high yield bond issuers upgraded in August exceeded downgrades for the 5th consecutive month. Specifically, August 30th saw 30 upgrades impacting $49 billion and 21 downgrades, totaling $20 billion, registering a 1.431 ratio to upgrades to downgrades. So look at this. The chart's inflecting upwards.
Mm-hmm.
So everyone's calling, the rate cuts are bearish, but they're not even looking at bonds. Rate cuts were bearish in 2008 because the bond market was falling apart. And I remember I was working at KBW. This is a good story. And there's this old bond trader who's like, I think he was in like the book Liar's Poker. And he looks at me like he just smoked a cigarette. And he's like, Tyler, you think stocks are going to be up and down 6 months from now? And I was like, right out of college. And he was like, they're going to be down 35% at least. And so the bond market was telling you in 2008 that it was imploding. So the rate cuts were seen as a bearish thing. Like, oh my God, but this is the legit opposite of this. So I don't know, there's growth, large cap tech. I'm not like super bullish about, but industrial stocks are on fire. Utilities are on fire. Banks are about to break out to the upside. Like this is everyone bearish. Like what's going on here?
I want to touch on that point on Joseph's point, because I tweeted something to actually combating that, and which is I think Joseph's going to be right in 2025 when inflation is a problem again and the Fed is still too easy. That's going to weigh on the dollar, where you're going to see the situation of rising yields, but actually weakening dollar because people are losing credibility. The Fed's losing credibility. People are losing trust in U.S. asset markets. But in the meantime, if you believe that Fed rate cuts will stop the bleeding, and by them going 50 and giving a very dovish dot plot, that is that signal that we're ready to stand by the economy and the labor market. So I take them at their word, and I believe that the economy is actually not that bad. And so what that does is it actually removes accommodation out of the monetary path of policy, because they've stopgapped with a 50 up front and removes cuts and actually makes interest rates rise, yields rise in the market, and bolsters the dollar because there's less recessionary fears. I think, to your point, Tyler, the other aspect on the sentiment part is, for nonstop, September was the bad seasonal. Now we're breaking that. And the next one is, I think that's going to get broken is, very dangerous pre-election, stay out of the way of risk. I think stocks can't move up. I can't tell you how many times I've heard that 5,600 is the ceiling on the S&P before the election. I'm like, guys, what are you just regurgitating these notions that, no business managers can't make hiring decisions and purchasing managers. And I'm like, the world's fine. Just go about your business. It's not going to Trump, Kamala, it's going to matter around the edges, but the macro is going to rule over a medium, multi-week, multi-month horizon. So I think that's going to be the next commonly, regurgitated narrative that's broken, and the fact that I think we're just kind of going to go up. And to Felix's point, if the spice is flowing, the Fed liquidity, and stocks are expensive, they're unlikely to crater. So there's kind of a floor on stocks. Maybe the multiples are expensive, so maybe they have to chop wood. They do these things where they sprint up, chop wood, sprint up, chop wood. But the spice and the liquidity is still flowing. And so that's why it's very constructive for Bitcoin and gold. And you see these inflation hedge assets coming back as oil is getting priced higher for this growth. Look at China stock breaking out. So I think you are seeing this global rest of world trade. It's the glimpse. Just like in July when we saw the glimpse of the small cap trade, I think this is the glimpse of the rest of world trade that actually is really going to play out in a bigger way in 25 and 26.
Yeah, I think the rest of the world trade and like hard assets trade. I mean, looking even at the price action today, like SPY is down 0.8% on the same day that gold's up 1.1%. That's sort of the vibe that I'm getting. So I mean, what we're talking about here is basically the trajectory of the cutting cycle, and I really like this chart because it shows the path that is currently priced in versus previous historical cycles. So the big thing now, and this is something that Powell actually mentioned in the press conference, where he really emphasized this fact that he believes neutral rate is significantly higher now. That was pretty interesting. That was probably the only, marginally hawkish thing that we heard. And it's something that, market participants have been talking a lot about over the last year. So it's good to see them take that seriously. But what that's effectively, causing here is that the market is implying that, that neutral rate is around 3%. And we're just doing a quick, swift move down to 3, roughly speaking. That would make us show like a return to neutral. I wouldn't say that this is, recessionary pricing by any means from the bond market. But what is interesting is that when this 50 bips cut came in, the long bond yields started to surge higher, and they've pretty much been in an upward fashion since. And I think that gets a lot to what Quinn was talking about.
Yields higher, Felix, not price higher.
Sorry,
yields higher.
Yields higher, prices lower, TLT's down, long bond prices down. And I think it's because by going so hard so quick, it's nipping it in the bud, and that is making for less cuts priced in. So I want to tie this into Joseph's comment about the Dixie heading lower, the US dollar heading lower. I personally feel like when you look, and I've been ranting a bit about it this week, it's just like implied forward differentials in currency markets. Like when you look at the Dixie over the last month, it's just been down only because we priced like an incredibly quick and swift cutting cycle. That gets priced into currencies. That's why we saw yen at 140. And basically ever since this meeting, because they're cutting so aggressively so soon, it's going to make for a shorter cutting cycle overall, which means that those implied forwards need to price it out. And, we've seen the yen go from 140 to 144. The BOJ didn't hike last night, which also helped that. So I feel personally like that move has already happened. And because they've gone so aggressive so soon, we're actually going to see a shorter cutting cycle, which means less US dollar weakness.
That's interesting. This chart, do we know is it from JP Morgan?
No, I forgot who it's from.
Okay. I think it has a mistake that I'm sure the person who created it is aware of. It's not a mistake. It's just a issue that I think it's not correct, is that it's assuming that the where we're starting from, the highest point, is the same. Like in 1984, they didn't start from 5% and cut into negative 75 basis points. They probably started from like 12% or something. And in 2019, they didn't start from 5%. They started from 2.25% and went down to 0, not 3%. So like, I think if you're at 12%, of course you're going to cut more than if you're at 1%, but so I think that's a little bit of an issue. I think the general thing that it shows is that the Fed Reserve cuts a lot when it cuts. I think that's just true because cutting cycles have been bigger than hiking cycles, and that's why interest rates have been going down for the past 40 years. But I want to go back to something my good friend Tyler said. He said, so I think your chart of the fund manager survey, that is I think a accurate sentiment tell. If all these fund managers are saying that we are not loaded up on risk, I believe that, and that's interesting. That surprises me. I would have thought that they were more. Maybe it's households, not professional investors, who are overweight, but I think a lot of the market is overweight. But just because they can get more overweight, it's not necessarily bearish. I do think the CFO thing, like if you're a chief financial officer, I think that it's you don't want to fade that. Like I'm sure going into a recession, chief financial officers are bearish, and if 10% of CFOs are bullish, like that's not a good sign. I'd rather have 90% of them bullish. I'd want to go with the trend, but I don't know. I haven't done the work. High yield, you're absolutely right. I think I don't believe in the word de-risked, but I think the risk in high yield is lower because the worst deals have been refinanced into the private credit market, and that is, the word bubble just like is a very judgmental word. It implies like it's going to collapse. But I do think that private credit investors, like they have been taking the marginal credit risk of financing leveraged companies, low quality speculative credit. And obviously taking credit risk has been the correct trade over the past 2.5 years because there has not been a recession. And interest rates have gone up. So that's why you have all of these chief economists and strategists from these private equity firms. They believe in the no landing because they want high nominal interest rates and then no recession. So credit performs well. And that's why, Ares, Apollo, they've been performing well. But interesting Odd Lots interview with someone from PIMCO who, talking their book, sounds like they're pretty long duration. But private credit, like
selling duration, eh?
Ooh, wow.
Even if you own a high yield bond, the spread blows out, you do get some protection because the risk-free component comes in because the Federal Reserve is cutting interest rates and the Treasury yields fall. You don't get that at all with floating rate securities. So yeah, I think so. But maybe the private credit thing is not going to pop until 2 more years, 3 more years, and I don't see any evidence why it has to be a systemic financial crisis. I think the more likely outcome is just subpar performance for fixed income investors. But they can handle that.
So basically what you're saying is that like something like HYG, which is like publicly securitized high yield issuance, is not capturing that credit risk because it's been offloaded into private markets.
Yes, it's partially you're saying. Where I do agree with Tyler is I think dovish cuts are everywhere and always bullish, all things being equal. A lot of the time, the reason there are cuts is because there's a crisis, and that's obviously not bullish, such as 2008, 2020. But I think, like all things being equal, let's just assume that they were always dovish. I never really believed into the high interest rates or stimulative, game. But so low interest rates will stimulate capital markets activity, and I think high yield bonds, investment grade bonds, mortgages, as Quinn referenced earlier, maybe even some IPOs, which have been lacking, even though the stock market is at all-time highs, which is interesting. So yeah, I think it will stimulate capital market activity, which is bullish.
I want to touch on the point credit markets because I spent the first 5 years of my career on fixed income high yield credit side and worked with a lot of these private funds.
For that baby face, he actually spent 5 years in a credit.
Yeah, you gotta.
I feel like most bond traders look like they're 60 when they get out of college.
You need to smoke more cigarettes, Quinn, or something.
Yeah, I need to spend more weekends in France, and I'll be right there with the raspy voice. I should have a dart right now. No, but basically what's happening is it's the same route that's happening in the public equity markets going to private equity because for whatever reason, people, long-term investors like to see no mark to market. So they sleep better at night thinking that magically their private equity owned businesses don't take the same drawdowns as the public stocks in the same way that crypto venture investors think their mark to markets don't take the same drawdowns that the liquid tokens take. And so that's just really what's happening in the private credit. I pushed back actually on this notion of offloading risk into the private markets because actually the deals are more sound because in the private markets, the lenders have more leverage and control and say versus in the public markets. It's like, think of this, you're issuing $500 million to 200 investors and they each take a little piece and none of them actually have it's a more diverse group. And these private ones are more like club deals where it's like me and 2 or 3 of my private credit buddy shops going in and kind of hounding the companies, getting tight covenants, etc. I think your point, like fixed income is just going to suffer in a secularly inflationary environment from a real returns perspective. You're going to lose purchasing power relative to other assets. But we're not seeing credit problems. And I think, Tyler, you put a chart like this, whereas the bubble in the debt markets is at the sovereign level and they need to get their way out of it.
Yes.
You look at this crowding out effect look at the ratio of issuance. This is leaking some alpha here, but the issuance of investment grade and high yield debt volumes relative to sovereign debt volumes issuance over the last few years. And you will see that crowding out effect happening real time, which is making the CFO survey, tying this all together. The reason all these CFOs are bearish is because we've got a two-speed economy where lifting the front end interest rate at the Fed has crushed small business, small banks, regionals, and crushed bank lending. That's the majority of these CFOs around the country. It's helped the Amazons, the Googles, the Microsofts, the NVIDIAs, and that's brought enough economic weakness to the labor market because small, medium-sized enterprises employ the majority of the workforce in the States to get the Fed to ease. But at an aggregate level, because the government's spending so much, the economy actually is still okay. Flight traffic and foot volume and consumer and retail sales, all these things are actually fine. And so what the Fed's doing now is stimulating into what has kind of been like the second or third or fourth of these blips where we've had these mini, downshifts in the business cycle over the last 4 years. And now it's going to reinflect higher. So I think it's going to be looked back on as a policy mistake. Like everyone, had their undies in a bundle about like, oh, they should not do 25. And it's like, and I was saying they should do 50. I don't think they should do 50, but I thought they would do 50. And, you got to play the cards.
Exactly.
Like everyone yelling at the Fed. It's like, if you lose money, yell at the Fed. Like, no, if you're smarter than that, then you can have the view that they shouldn't have done something, but also have the view that that's what they were going to do. And it's, this magical world of public markets.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Teffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code FG10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show.
Here's my thing. All this like deliberation of dot plots and issuance and all this nonsense. Here's the politics of it all. We have $1 trillion deficit. We have declining demographics. They are going to print and issue so much debt to get growth so that they can pay for the debt and lower interest rates. It's just, no matter what happens, this is Ponzi finance. Since the debt bubble has been transferred to sovereign balance sheets, my big read for the next 10 years is that developed markets are going to go on the biggest fiscal super cycle that you've ever seen. You're already going to see it. They're talking about it in Japan. They're talking about it in Europe, especially Europe. Europe basically gave up their sovereignty to China, and now they have to basically reinstill domestic growth. And if you see the GDPs of Europe in the US over the past decade, the US just completely blew them away, and they need to do something. So you're going to have so much government spending, especially as our generations get into power, and you see these older people drop off in boomer politics, and the amount of government spending is going to be nuts. And you're going to have nuclear power to keep the inflation at bay. You're going to have pump a lot more oil here. OPEC is going to break up. There's going to be a lot of weird stuff that happens. But at the end of the day, my point is that they're going to lower rates because you can't have $1 trillion deficit when you have Medicare costs that are just skyrocketing. It's just, so we're going to have I think we're going to have a massive boom in assets, and we're watching the first turning. One of the things, I'll stop on the rant here in a second, but this morning you got this headline: Microsoft's AI power needs prompt revival of 3 Mile Island nuclear power plant. Constellation to invest $1.6 billion to restart dormant reactor as data center power demand surges. So this I think is really important just from a secular standpoint. We went into secular stagnation after 3 Mile Island blew up, and when nuclear power went into the background, in 1979. And that you could say that's where the innovation of atoms really stopped. And, Peter Thiel talks about this all the time, but the innovation of bits took over. I think this is a turning point. And no one will remember this headline, but in 10 years, they'll be like, oh my God, they restarted 3 Mile Island. And that's a sign that we're turning back to, this is a first turning thing where we're turning back to invest in our developed markets. And the next generation will actually like create new institutions and hand it off from the old. That's why like IWM is breaking out here. And I think you're going to kind of see some of the old companies, pass the torch.
So I also noticed that headline, Tyler. It was very interesting. I think that the power demands of artificial intelligence are as immense as we are reading. I don't know if that's a reason to buy low quality oil exploration and production companies. Like I think that it probably, you're right, probably nuclear, and it probably demands for electricity will be large, but like oil does not produce electricity. It's natural gas, and maybe the price of natural gas is going to go up. But historically, there's been a lot of natural gas in America, so we'll see.
I'm actually saying almost the opposite, where I think if you lower interest rates, it actually increases the amount of oil because the financing costs are easier, so you can pump more and more and more and more. That's what I'm saying. It's like I've been thinking about this whole commodity thing differently. You have to do a lot of fiscal spending to really stew inflation, but that chart of commodities versus assets, and it's just like it goes up and that goes down and then goes up. It'll probably go down, but I'm thinking maybe this time is different, which is Mark Andreessen says the purpose of technology is you produce more and more with less and less. And if we had this if AI is real, you can produce more and more commoditized goods with less and less. So maybe we're in a secularly disinflationary period, and the government spending will cause, real growth to kind of stew while you keep the inflation at bay is sort of what I was saying.
I like that a lot. Guys, I want to talk a little bit about what we see coming up next. So, based on everything we talked about with the Fed meeting, the next meeting is not till November, and it's expected right now to be likely 25 bips. But a lot of that, as has been very explained by Chair Powell, is driven by the labor market now. And so it was quite interesting for me. I just want to run through a few slides of just some of the economic data that came in this week on the eve of the big 50 bips cut. I felt was kind of funny, but retail sales came in pretty strong. When you go into and look at, like retail sales ex at gas autos, it came in a little bit below consensus of like say 0.3%, came in at 0.2. But overall, pretty decent retail sales for where we're at in the cycle. And then same with jobless claims. We saw a below consensus print on the initial jobless claims. And if you look at just the trend of jobless claims on a 4-week average right here, it's just been trending lower and lower for the past couple of months, which to me feels like quite the contrast to what we're seeing in terms of what is being talked about in the unemployment rate right now.
Yeah, there definitely is a disconnect, absolutely, between the unemployment rate and the jobless claims. Wait, Felix, go back. So 2.1% year over year retail sales. So in terms of adjusting for inflation, that's negative retail sales growth, right?
Yeah, I guess this is nominal, I believe. Let's see if I can see what real.
Yeah. I mean, look, consumer spending has been by far the strongest part of the economy. So it's just a little a bad month. That's fine. I'm not saying consumer spending has been weak, but I would not, if that's nominal, I would not refer to that as a strong print.
Yeah, I would say just above expectations, but not actually. Yeah. I should be more clear about that. It's surprise to the upside, but it's still in terms of heading in a lower trend. And then this was an interesting chart. I just want to pause here for a sec. It's just from Eric Bajmani of just the initial jobless claims, non-seasonally adjusted compared to the last few years in terms of where we're at. And so the blue line is the current year compared to previous averages. And if we're on the verge, or if you adopt the Somm rule thinking that we're in a recession, my personal opinion is that we would see this above trend quite significantly.
That is interesting.
Yeah. So, I look at things like this and I look at them getting in front of, going big on the first cut on what seems so far to be largely proactive. I wouldn't say entirely reactive. I don't know. I feel like that left tail's getting cut pretty hard here on the recession idea, but I don't know. I mean, Jack, you interviewed Daniel DiMartino Booth, and I listened to that, and there's some interesting. Like, I know she thinks we're in a recession right now, and I'm really trying to understand that idea. Like, what were some of the takeaways there in terms of like how she's seen this labor market? Because when I look at something like this, it's like seems like we're okay.
She's tracking layoffs, and she basically think that non-farm payrolls have been drastically overstated. So the strength of the labor market, as how many jobs are being added each month, which was being quoted in 2022 and 2023 as a sign of a very strong labor market. I think over 1 million jobs have been revised out of the non-farm payrolls. So yeah, she has a lot of examples, data points and stories that don't get a lot of attention that aren't in the overall aggregate. So I think she definitely would challenge the non-farm payroll data. She thinks it's a lot weaker than the actual data supports. And I mean, Powell and many other economists have acknowledged that the non-farm payroll data could be a little overstated. My question would be if the non-farm payroll data is indicating this level of strength, a very high level of strength, and it's lower, that doesn't necessarily mean that it's very weak. It's just less strong.
I gotta say, Danielle DiMartino Booth, love her stuff. Think she's brilliant. She's been a bear for about 16 years. So I mean, Carvana's up 3x this year. I mean, let's stop talking about a recession. It's until I see some pre-announcements and Oracle doesn't rally, 15% on earnings. I just don't. It's crazy. It's crazy. I love the sentiment for me because it's a contraindicator, but like, it's kind of crazy to me. The high yield spreads are like at record tights. In a normal recession, they're like blasted out to 1,000 basis points. So all this stuff is just, it's a great story, and you get a lot of followers if you're bearish. You sound smart, but like, I don't know what you're looking at in terms of market.
Tyler, I'll give you this. Certainly this would be, if we're already in a recession, then high yield credit spreads are among the tightest they've ever been in a recession, or definitely the way. I mean, my data going back to 1997, they're definitely the tightest they've ever been.
My tune will change if they blow out. Like, yeah, we'll start paying attention to what's going on here. But like the balance sheets of like, I think there was like a massive upgrade in like Dish Network in high yield. Like that doesn't happen in a recession. You don't see that type of stuff. Like deleveraging from these high yield guys just doesn't happen if it's a recession.
In the same way, if someone is a recessionista and they have some anecdotal data, like I would be careful on that. I'm also careful about, Dish Networks got upgraded. Like, you got to have a bird's eye view. I will say on Carvana, like the market was pricing in a bankruptcy. And I know some very smart people who thought that Carvana would go bankrupt. And so, yeah, if a stock is pricing in bankruptcy and for a fact that 2 years later it won't go bankrupt, you definitely want to buy the stock.
It's kind of surge, yeah. I mean, look, like you look at something like the Beige Book, which Powell referenced in his press conference, a sign that like drove part of the decision to go 50 bips. That thing is not that rosy either. So I admit that. And that's like a good reference point of not being entirely anecdotal, but it's this good hybrid of aggregated data that you can back up that's still somewhat anecdotal and like right from, business operators. So I do respect that. Like there's when you're in the trenches talking to these operators, it gets back to this idea of a K-shaped economy. It really feels like that. Is that when you look at like top level down aggregated data, that's especially like market driven, things seem okay. HYG, on a total return basis, hitting all-time highs every day. But yeah, then when you look down into the lower, income streams and parts of the economy, it's a lot rougher. So I do totally respect that. And it's hard for us to reconcile both.
I agree. Like Dollar General and all the lower tier consumer or lower income consumer is in a lot of pain, and credit card delinquencies are skyrocketing. I'm not Pollyannish about this. There's really bad things happening. It's the best of times and the worst of times. I mean, we're really turning into Gotham. It's just that like, if you're, it's partly what happens in a fourth turning, right? You have this disparity between super wealthy and the middle class gets annihilated.
This all goes back to how governments have conducted policy. You have the Treasury stimulating at these deficit levels irresponsibly, and the Fed financing that via depressing long bond yields in the market by 100 at least basis points, and hiking the short end to conduct their active Jack. Barry Knapp is the absolute GOAT. I've been talking about this for ages, and it's just because, so like taking a step back, you have to like think about where this data is being pulled from. It's being pulled from these CFOs that run these small, medium-sized enterprises that have gotten crushed because their financing costs have never been higher. Their inflation, wage increases, that costs have never been higher. Their employees are upset because they can't afford groceries. But then what those surveys aren't asking around is the tech sector, the Amazons, the Googles, the government and education and healthcare workers, where all the job growth is coming from. So like these things just put a floor on the economy. And then zooming out of all of this, you're saying, okay, GDP is at where it's at, 3% estimated on the latest Fed now. Inflation's at where it's at, basically 2.5 to 3. And the unemployment rate's still historic lows, credit spreads historic lows, and we just got a 50 basis point cut. So these regional banks can now lend profitably on a steep yield curve where they can borrow short and lend long. And you're seeing this inflecting. It's like to the point about recession, it's just like, I think there's just the market continues to give something for everybody. Recession, you can find points to point to recession. You can find points like what was the data point I saw? It said the Fed's cut 20 times with stocks at all-time highs, and every time it's been higher or whatever. Like I just love like this is where my bias is. So that's
you can find a back test for every view. I love Barry Knapp too. I think that a lot of capital market activity does price off of short-term interest rates. It's a myth that it's the 10-year, it's the 30-year that is what is the only thing that matters. Like all business loans, bank and private credit are off of that short-term SOFR rate.
It's all off SOFR,
Yeah. But
bonds
are,
and the big large caps finance off the end, and the sovereigns and the large caps investment grade are 10, 30-year duration, and the small businesses, the regionals, the private credit, it's huge for private credit's borrowers. For the health of private credit, think about that. All the private credit's companies in private equity in their portfolio companies just got their interest expense slashed 50 bips, and they're levered to the gills usually. So
short squeeze. That's how bull markets start.
It's unbelievable. Yeah. I mean, I think breadth and, stocks that just pushed to all-time highs and everything, but I struggle. I can't find a reason to fade this. It's just
in the short term, it definitely feels a little overbought sentiment in the very short term.
I'm talking multi-month.
Yeah, zoom out. This is the liquidity cycle and Michael Howell's liquidity cycle just playing out perfectly. And it's global. I think I have a chart showing like nominal yields of all the developed markets are just rolling over on the 10-year yield. And we're probably going to go back into some sort of like negative real yield situation. And the market's going to be ripping.
I don't believe that.
Months.
But the last point I'll say on this is people need to really, in their minds, separate the strength of the economy and financial markets and equity prices, because similar to 2022, how this is all going to end again is the next wave of inflation. I'm of that opinion. I believe the Fed will stimulate enough to save the labor market and the economy, and that'll reignite growth, reignite bank lending, and inflation comes back. Mix in a little geopolitical risk and oil's back at $90, stuff like that in 2025. I don't think it's necessarily near term. So people need to, I think, really make sure they're kind of carrying a framework that delineates between the strength of the economy, which 2022 risk assets rolled over because inflation, Fed was behind the ball, but it was not because of a recession. That's why you didn't see credit spreads go bananas and things until later in the move when we had the Bank of England stuff. So I think that's how this ends, where the economy gets so hot that asset markets eventually kind of have to, because of rates.
Quinn, if you're right, if someone told me everything Quinn just said is going to happen, of course I'd be, super bullish on stocks, because that basically means the Fed's dog money is going to happen. No, and that inflation will continue to fall as the unemployment rate doesn't go up. That's the definition of something.
Okay, but Lucas, I want to ask you, do you think the Fed on its own, with its own tools, can create enough inflation? without the hand of the fiscal authorities and Treasury and
No,
putting up fiscal
6%.
stimulus. But okay, so like, what's our target here for inflation? Like, I agree, there's going to be a resurgence in growth. Does that include inflation in terms of like any sort of meaningful uptrend that causes the Fed reaction function to change? I mean, we look at like what's occurred from the Fed, obviously like 2008 until 2020 is a pretty unique time. But when you look at just the historical basis of what the Fed has done, lowering interest rates, QE, et cetera, those things didn't lead to, like Michael Howe puts, is like, Main Street or like high street inflation. It led to monetary inflation. But do we think this can actually occur without the fiscal? Like, if we get a split Congress that doesn't get anything done and they're just yelling at each other every day, like, do we even think inflation can come back to that degree?
I love that point, because I think this goes to my point about, if you lower rates, you pump more oil, right? It's actually disinflationary if you lower rates. Just with lowering rates, you need the fiscal impulse to really push the growth in the inflation up. That's sort of where I'm at. Where if you got that split Congress, on a side note, how come every Canadian I know knows, the U.S. U.S. citizens? It's hilarious.
Tyler, I'm also, I guess, where is oil? $65. So 71. I think oil will stay. What is it, Tyler?
71.87.
71. Okay, yeah. I don't think oil is going to go like over $100. Some very well-informed people I've talked to said to me, I'm for guidance in January, that Saudi Arabia is keeping this market alive, and I just think that American companies are people like to drill, and this whole narrative of balance sheet discipline that people talked about in 2022 is totally false. Maybe they're not drilling as much, and they're not drilling so much that they are willfully going to go bankrupt like they did in 2013 and 2014. But I mean, just look at Permian production; it's up massively. And Tyler, I think what you said was definitely right about lower rates are stimulative for oil prices because capital market activity. I think like private equity funding oil doesn't really exist anymore. Like, I think oil companies finance themselves by share issuance, borrowing money from banks and family offices that are willing to lend to them, and funding from their own profits, which is easy when it's at $100 and a little harder when it's at $70. But I guess, yeah, I don't think like oil. The reason inflation went to 9% is because of oil, basically. Yeah. And really, oil went higher than it should have on an economic, supply and demand. It was just a lot of speculation that oil would be cut off because of Russia, Ukraine, which ultimately didn't happen.
Yeah, that was a trigger that led to, the Fed. I think it was after the Ukraine invasion where they started to do 75 basis point hike clips. Like, that's when they're like, oh crap. It wasn't like they were trying to be in team transitory as long as possible.
Right. And Michael Howe, he, like Joseph Wang, phenomenal track record on forward guidance. He does have something about a liquidity cycle and about how it goes up and down and up and down. I don't know exactly why that is the case, or how much I agree that it can be predicted based on a cyclical nature. But I think according to the cycle, like, we're pretty soon entering into liquidity going down. So I wonder if that is going to make Michael bearish.
Yeah, I think we're like 60 to 70% of the way in his model. But yeah, again, like it's a useful heuristic, but I'm not betting everything on that idea, because I don't know, the world's complicated.
What's the last little 30 to 40% is the banana zone.
The banana zone.
Both of you guys old roots. Your old roots are in the banana zone.
Yeah. Jack and I both worked with Raul.
We did. Yeah. So explain the banana zone for me. Is it what it sounds like, of just things go crazy? Because
I think the Fed cutting 50 bips into a healthy economy while liquidity's still fine, and risk assets.
I think global leverage goes up, and you get, a lot of, speaking of lowering rates, and you'll get leverage upon leverage when people start borrowing money. Money markets have let me give you an accurate $7.5 trillion in US money markets right now. That's a lot of money. And if they keep lowering rates, that money is coming somewhere, whether it's bonds or that's a cash bubble to me. And that chart looks like parabolic. It could be demographics, but still, if you're not getting paid for your interest, that's very, very bullish for liquidity. So I don't know. I think before it's all said and done, I think we get, a blast off here in some funky parts of the market. I'm looking at certain things like space stocks.
Yeah.
When you see space stocks really like breaking out to the upside, there's something going on.
But Tyler,
Dude.
ARK is still at $40.
I was about to say ARK is the signal for this. If
it's like in our first interview on Forward Guidance when you were a guest. That's funny, a guest turning to a host. That's funny.
There you go.
I think, Tyler, we're definitely not at a banana zone now. 2021 was a banana zone. It was a bubble in equities and crypto, but also the farther out on the risk curve, like the more higher the valuation, the better. The more speculative the business plan, the better. Venture capital companies going public that had no reason to go public, retail being sucked in at the absolute highs, scam artists, like we are nowhere there. And people who say the equity market is a bubble, the technology Mag 7 is expensive. I think the real, it's not a bubble, but it's just like exquisitely high quality companies such as FICO or Moody's or Chipotle. Not that I don't think Chipotle is that high quality company, but like they have price to earnings ratio of like, in FICO's case, 100. Now FICO, like probably in 20 years,
or like Costco, I think has a 4T of what?
Perfect example. These companies are all more expensive than Nvidia, and FICO's not doubling its revenues. Obviously, Nvidia is cyclical, blah blah blah. But if AI is real, Nvidia and there are a lot of companies that are going to be growing their revenues, and companies are massively.
Yeah, I think people are confusing like spurious correlation because look, they look at the crypto markets, they look at Bitcoin, and they say, oh, it's near all-time highs and it's been surging over the last year. I think that's largely ETFs, and if ETFs hadn't happened, Bitcoin would be on the floor with ARK right now and about to see the leg higher. I feel like that's the trade. Like those have correlated pretty strongly until the ETFs came in, and we saw this idiosyncratic move in crypto at the same time that we saw this idiosyncratic move in Mag 7 AI type narratives, which both have fundamental reasons to it. But when you look at crap like ARK, it's on the floor, and I feel like they would have been as well. And this is the time, like, keep an eye on ARK to understand banana zone and whether cutting 50 into a reaccelerating economy is actually happening or not. Because I feel like those type of things will go,
right. And everyone here obviously knows a lot more about crypto than I do, but I think like what you're seeing now is not 2021. It's basically just Bitcoin and the top stuff going up. And then there being a bunch of meme coins that everyone knows are nonsense, which are now going down. It's not 2021 where it's like we've got a project that we're DeFi and we are going to revolutionize supply chain finance. It's not like some big scheme that is going to get. There's no narrative. Yeah,
95% of coins have just been flat and bleeding. It's only been that 5%, and people look at that and say, "Oh, things are great." Go ahead, Quinn.
The analogy is Q4 2020. Q4 2020. Is and people have been trying like clowning me for this. I started with the notion in July. That's my my personal. I believe that is the best macro analog to right now.
Quinn, what's your favorite crypto project that you think is, you think is going to go up the most?
Are you allowed to talk your book yet or no?
I mean,
don't tell me Bitcoin. Everyone knows about Bitcoin.
ETH has bottomed. Market ETH bottomed.
I agree with that.
Guys, I got a duck though.
Yeah.
Sorry.
Yeah. But I like the Bitcoin miners with the AI story. I like those.
That's interesting.
They've run a lot, so do your own research. But I like those. And yeah, Bitcoin's. I think it's going to continue to do well, but I do think if you look at the Q4 2020, I think maybe we're in a November-ish area, and that would imply that we're getting very, very close to when other things should outperform. I am positioned for other things besides Bitcoin to start outperforming. So we'll see. It started this week. We'll see if it continues.
Yeah.
Interesting. I know we're going to go, so I just want to say my new show is Monetary Matters with Jack Farley. That's the name of the YouTube channel, and they're also available on Spotify and Apple Podcasts. A few people are complaining. It's like, well, we're not on Podbean yet, and these minor. But Felix, I mean, you know the data. I know the data. 95% of podcast downloads come from Apple Podcast number 1, and then Spotify number 2. So we'll get to the tertiary and the ones that 1% thing. We'll get to that later. But we got Apple Podcasts and Spotify. My first interview was with Joseph Wang. Second was with Daniel DiMartino Booth. In about an hour or so, I'll be speaking with volatility specialist Chris Sidiel. who in a bull market, I understand that his fund has been performing very well for a volatility arbitrage tail risk fund. So that interview will air on Sunday. And yeah, Monetary Matters, we're planning on episodes coming out Sundays and Wednesdays. And thank you so much for being gracious, Felix, and having me on.
Yeah.
And if I'm allowed, we'll put some links to Monetary Matters.
Yeah, absolutely. I love how you got in there before I could kick you out. No, just kidding. Well, look, no, I was going to open the roll out the red carpet for you, just like in Hot Ones, and this camera, tell people we got going on. But you already did that. But look, I'm very thankful that you trust me with the show that you built. I appreciate you coming on for one last send off. Into the sunset of Monetary Matters. I think the show is going to be great, and appreciate you coming on and giving your 2 cents before you head out. So, yeah,
thanks for having me, Felix.
Jack, I always tell Jack in our chat, I say I have a rule: I don't listen to any podcast religiously because I never want to adopt the views, and I just it's not healthy for creativity and open-mindedness, in my opinion. But I always say I hate because Jack always has these banger episodes, and I find myself listening to Forward Guidance. So it is a little bittersweet to see. I mean, I'll continue listening to your stuff, but it's awesome to be able to move the Roundup over here. I'm always like, God dang it, Jack! Quit releasing such heat that I have to listen to this. Congrats on your launch and good luck.
Definitely. Well, I always try to Forward Guidance to have a balance of views, and I think maybe people don't have this perception, but I'm just anxious that people have this perception that I only interviewed the bears. Definitely in 2022, like I had a bearish bias for guests, which was correct. But like once the stock market started going up, I was like, no, Jack, you need to have balance, and I think I definitely succeeded on that front. It's just that a lot of the bearish guests got a little more views, and that just reflects purely on the audience and not on me. Yep. And I'm going to try and do that with Monetary Matters. Danielle was somewhat pessimistic on the economy and markets. Joseph, which I did not expect, was pessimistic on the stock market. But I definitely, just as Forward Guidance, I will be planning on speaking with the bulls, definitely. And, Felix, I look forward to continuing your coverage. You may opt to say, no, I'm going to have my own views influence it. It's your baby now.
I want to be objective as well. And, I actually put out a tweet a few days ago asking around for the best recession thesis because, we have a lot of no recession theses lined up. And my personal opinion is no recession, but want to be objective, want to have other people come onto the show and test the thesis. So fully aligned with Jack's philosophy here. We'll be doing the same thing on Forward Guidance to have a balance of views. So
last thing I say is, like, if in February of 2025, interest rates are at 3.5% or 4%, and the unemployment rate is at 4.3%, I will consider the recessionistas to have fully lost. Like this, but this is the time though, and this is what recessionistas will say, is that it always looks like a soft landing up until the very end. But I think a 5 to 6 month window for the Federal Reserve to cut, and then it's a little too late, I think.
Yeah, agreed.
But it sounds like you guys are already there. You guys are ahead of me.
There you go. All right, guys. Well, that was really fun. Thanks for joining, Jack. All the best on the show.
Stuff.
Have a good weekend, guys.
Have a good weekend.
Thanks, Felix.